Hello and welcome, WMLAR members. Thank you so much for being here today. We are excited to offer these free Next Level Success Series webinars that are designed to help our members level up your professional game and tackle the real estate business challenges and learning gaps you may be experiencing right now. Today's topic is understanding your role as an independent contractor with attorney Rose Coonen. Rose focuses her practice on estate planning, business planning, and probate administration. Rose brings a holistic approach to serving her clients to ensure that they have estate plans and business plans that work when they need it most and to bring harmony in the most difficult of times. Rose's passion is serving families with children with special needs and authored the book, Estate Planning When You Have a Child with Special Needs, Plan Your Estate Well, Protect Their Future, to serve as a guide to parents. Excuse me. She works with small businesses from startups through succession planning and everything in between to make sure they have a strong foundation in place by helping to establish core legal, insurance, financial, and tax systems to minimize risk and position for growth. Rose is also a certified exit planner advisor, joining an elite group of business advisors who are on the cutting edge when it comes to the resources and knowledge needed to assist business owners through the entire cycle of creating, growing, and preserving wealth. When Rose is not advising clients, she enjoys spending time with her family, tasting a new wine, or reading a good book. Welcome to Rose Coonen with Coonen Law.
All right, thank you. So we're going to talk this afternoon about the independent contractor role. And like Andrea said, certainly if you have questions, go ahead and pop it in the chat, because sometimes while we're on that specific topic, it makes it a little bit easier to cover it at that point. So we're going to talk about some legal, operational, and tax boundaries when we look at the independent contractor role. So the first part we're going to talk about is that legal framework. So I've kind of broken it down into three different pieces. We have the legal framework that we're going to talk about first. And then we're also going to talk about some tax strategies. And then finally, we'll talk about some operational efficiencies when we look at the independent contractor role. So as an independent contractor, maybe you're thinking to yourself, well, wait a minute here. I feel like I'm working a job with no benefits, right? Because as an independent contractor, you are your own boss. And that's one of the key pieces, is that you don't have benefits from an employer because you are the employer. And so with that, we want to make sure we're in compliance with the legal boundaries that are set for independent contractor relationships. So as realtors, you are independent contractors working with your broker, and the IRS has a compliance framework. And if you're not in compliance, the ramifications there are that the employer potentially is going to have some tax consequences. So with realtors, there is a safe harbor that the IRS has. And essentially, you're a licensed realtor. Your compensation has to be based from sales or commissions. So it's not an hourly rate is how you're compensated. And you have that independent contractor agreement with your broker. And if you meet those requirements, then congratulations, you're an independent contractor for IRS purposes. When we look at other industries, though, the court is going to kind of look at some other pieces. So with an independent contractor, you are your own boss. What that means is, while you have the freedom, you can set your own schedule, you can pick your own clients, you can control your branding and strategy. The downside, though, is that all the liability shifts to you. And so you have to also make sure you're protecting yourself from a liability standpoint. And all the tax liability also falls to you. And so you want to make sure you're setting yourself up so that you're managing that potential risk and liability. And we're going to talk more about what that means. So the trade-off here is when you're your own boss, right? You can have all the success you're willing to work for, is what I like to say. And so while your compensation's based on those sales and commissions, you also have unlimited potential. And so this is where, as we go through the presentation, we'll talk about some additional ways that you can build on top of that, depending on what your own personal and professional goals are. So when I mentioned earlier, the IRS has some other things that they will be looking at when it comes to the right to control and independent contractor status. So this is going to apply if you happen to hire staff of your own, right? If you have assistants or you have people that work for you. You want to make sure that if you are calling them independent contractors, that they truly are independent contractors. And the IRS has a test that they apply, and it's the right to control. If you have the right to control someone that's working for you, or even if your broker has the right to control, there's a tipping point where if it's too much control, you might be an employee, okay? Or workers that you have might be employees. And the reason that the IRS is looking at this is because as an employee, they're going to collect the taxes, right? Independent contractors are responsible for their own taxes, and the IRS is going to, it's kind of a balancing test. There's not like we go through all these factors and tally it up and see which bucket you fall into, independent contractor or employee. But they want to make sure that if an employer has the right amount of control, that it's an employee, that they're treated as an employee. And the reason for that is employees are entitled to certain benefits, right? Taxes are withheld. They might have benefits, 401k, insurance, workers' comp, things like that. Whereas independent contractors don't have those benefits. And so when it comes to the broker standpoint, there has been some opinions that if the broker is controlling things like safety and ethics, that is okay. Okay, an employer can control those things and it's not going to cross into the level of control where now you're an employee. So they can require things like that. But as far as other trainings and meetings, they have to be more discretionary. Okay. If they're mandatory meetings or you have to be in the office at fixed hours, that leans more towards an employee because it's more controlling, right? They're controlling more how and when the job is done. So same thing to keep in mind if you have an assistant or someone that's working for you. If you have this type of control, we want to make sure they're categorized the right way, whether employee or independent contractor. And then as far as financial control as well, who's providing the tools to do the job, right? So who's providing the car, the phone, the laptop, right? Whatever tools are needed to do your job, who's providing that? Advertising maybe as well. If the employer is providing that, that's more like an employee. Whereas if you're providing those things, that's more an independent contractor. An independent contractor is going to bring their own tools of the trade to the table. Same thing if you have an assistant, though. If you're providing them with a phone and a computer so that they can help you, then more than likely an employee. And if you do, by the way, have someone that you have hired that is working for you, you really want to make sure you're not misclassifying them because if the IRS disagrees with you, and you've treated them as an independent contractor, they can go back after all the withholding tax that you haven't paid. The Department of Labor will get involved, the IRS, the state of Michigan, and on top of those taxes, they're going to assess fines and penalties. And so that's not a great day, right? So we really want to analyze this and make sure we have workers classified appropriately. And then being an attorney, we love contracts. We want to make sure it's documented. So there should be a written contract when there's an independent contractor relationship. So it's very clear as to what that is. And that contract should then be written with all of these factors in mind to show that there's not too much control, that the tools of the trade are being provided by the contractor, there's not benefits, there's not taxes being withheld. And so that would be like your contract that you have with your broker. And if you have an employee, you want to make sure that, or independent contractor, that you have that spelled out. And that independent contractor agreement is pretty critical. Again, if you misclassify somebody, it potentially could be a class action lawsuit. I have had a client who they had workers that were classified as independent contractors, and one of them disagreed and said, okay, this crosses the line to too much control. And we really are employees, but you're classifying us as independent contractors. And they filed the class action lawsuit in federal court. So that means a lot of money, right? And those employees, those workers were alleging that not only were they not paid minimum wage for all the hours they were putting in, they weren't paid benefits, their taxes weren't withheld. That can, for a small business owner, that can almost like put you out of business at that point if you're facing that kind of litigation, regardless of whether you prevail. And so having that contract being clear, we're just clarifying that. And so the independent contractor agreement that you have with your broker, that is just essentially codifying your autonomy, right? That you are your own contractor. And again, when it comes to control dealing with safety and ethics, that's not going to be too much control. So they can require things like that. The second part is looking at some tax strategy. So I guess I have a question for you. Maybe you can put this in the chat. I'm just curious, how many of you have an entity that you are operating as, like an LLC or a corporation, or are you operating as a sole proprietor? If you could just put in the chat. Okay. So there are some of you, it looks like, that have an LLC. Perfect. Sole proprietor. This is our next piece. We're going to talk about this. There comes a certain point where you can try to maximize efficiency and save taxes with the type of entity that you have. Now, what I'm going to talk about doesn't mean that everybody should go out and create an LLC or some formal structure. A sole proprietorship might make sense. I'm just going to show you the pros and cons, and then you can decide. Because if you're an independent contractor and you have not taken any steps to formally create any type of entity, then you're a sole proprietor. Okay. What we talk about here is how can we save on taxes? So when we look at money that you're earning, right? If you're a sole proprietor, if you're an LLC, that is your gross revenue, but you still have to pay tax from that. And so where we see independent contractors get in trouble is where they're not setting aside the funds to pay their taxes, their self-employment tax. And so just to kind of give you a best practices tip, I would recommend that you set aside 30%. so that you have funds there to pay your taxes. Okay. So that's like level one. Level one, just make sure you're setting aside about 30% to pay your self-employment tax. Um, if you're a sole proprietor and you're receiving those funds, you're paying, because employment tax is not being withheld by the employer, you're paying double, right? You're paying the employer portion and the employee portion because you're self-employed. And so that means you're paying more in taxes as a sole proprietor, or if you have an LLC where you're just a disregarded entity. So if you have an LLC, what I mean by that is you have an LLC where you are just like filing a Schedule C. Like if you have a Schedule C on your tax return, then you're a disregarded entity. You're paying the self-employment tax. Okay. There are ways to minimize that by becoming an S corporation. Okay. So if you have an LLC, well, let me back up. An S corporation is just a tax election. It's a tax election that you want to be taxed as an S corp. A typical corporation has double taxation. So we don't want to be taxed as a C corp because then you're paying tax on the income and then you're paying tax again when you take it as a dividend. With an S corporation, we get rid of the double taxation and we can reduce that self-employment tax. So for those of you that have an LLC, but you're filing a Schedule C on your tax return, it may make sense to have a conversation with your CPA as to whether or not you should make the S Corp election. Because then what we do, let's say you have 100,000 in net profit, you are, as a sole proprietor, you're paying that 15,300 in self-employment tax. Okay. But if you're an LLC taxed as an S corporation, what you're going to do instead of claiming that whole 100,000 as your income, you are going to pay yourself a salary. So you think of it like your LLC is your employer and you're the employee, even though your LLC may be an independent contractor with your broker. Now you only pay the self-employment tax on your W-2 salary. And then the rest of your revenue, you get distributed to you as a dividend out of your LLC, which is then tax free, and you're not paying that self-employment tax. Okay. So this is something that just is a simple strategy. Depending on your CPA, I would talk with your CPA. So here's my legal disclaimer. I am not a CPA. I am not a tax expert. But these are simple strategies from an entity standpoint that may save you significant funds. And so it's worth the conversation. Some CPAs will say it's not necessary to become an S Corp until you hit a certain level of revenue, and they can help you calculate that to see at what point does it make sense to take that step, because you don't want to do something that's not going to save you money. So the different types of entities that you can become. So those of you that said you are sole proprietors, you have no liability protection. Okay. So with a sole proprietorship, they're super easy to set up because you don't have to do anything, right? It's the default. You just start doing business. But you have no liability protection. So if you're sued, that means all of your personal assets are also at risk. The benefit of a sole proprietor is from a tax standpoint, it's on your 1040, right? There's no separate tax return you have to do. It's just a Schedule C. There's no asset separation. So all the assets of the sole proprietor are your personal assets as well. Where that becomes an issue is if you're building something that you might want to sell in the future, right? So depending on your personal and professional goals, if you are looking to, if your goal is you just want to make an income, work, Sole proprietor may be fine. If you have a lot of assets that potentially could be at risk, you've got a lot of liability. But it can't be sold because with a sole proprietor, there's no entity. There's just assets, right? Which might just be whatever tools you're using, a computer, a phone number, a website. With a sole proprietor, you also have a higher risk of audit with the IRS. The reason for that is because there's no clear separation between you and your company. Okay. Maybe you have a separate bank account, maybe you don't. Maybe it's just your personal account, but because of that, there's a higher risk for audit. With an LLC, now you create an entity through the state of Michigan, and we're going to talk about how to do that as well. I like to think of that as a little bubble of protection, and that LLC can be the independent contractor working for the broker. Okay. Now you're giving yourself limited liability because we're creating separation between you personally and the LLC. Think of it as this little bubble of protection, and everything with the business is happening inside the bubble. Everything outside your personal life is happening outside. So that protects your company, your business from your personal life. So let's say you're in a car accident and somebody sues you and you have damages that exceed your policy limits, they can only come after the funds you pull out of that LLC. They can't come after the LLC itself, right? And flip-flop it, if you're sued professionally for something, they're limited to what's in the LLC, which is maybe a bank account, future commissions, but it protects all of your personal assets. So if you have additional properties, rental properties, it can give you that protection. With an LLC, if you are the sole owner, it doesn't really add a whole lot from a tax standpoint. You still can file that Schedule C on your tax return. It's a flow-through entity. What that means is all the income for the LLC flows through to you personally. But now we've got that strong separation of assets, which gives you the limited liability, and there's less risk of audit because we do have that clear separation. And then we take it a step further and we can add that S Corp election. So we're going to have the same limited liability. Now, instead of all of the revenue flowing through personally, which by the way, with the sole proprietor and the LLC, with all the revenue flowing through to you, you're paying self-employment tax on all of that. When we have the S corporation, now we separate how much is your salary and how much is a distribution. The salary is what you're going to pay self-employment tax on. The distribution then is going to come out to you tax-free. So we can save some taxes there. The key with an S corporation is that salary has to be reasonable. So you can't say, I'm going to just pay myself this little salary and take the rest as a distribution. That's not going to work. It has to be reasonable. And so I like to have the CPA involved in that conversation. They can help you clarify what a reasonable salary should be so that you, again, are reducing your risk of audit there. And then you still have that asset separation, which is giving you limited liability. The difference with an S corporation is it is going to file its own tax return. So from a tax preparation standpoint, you're increasing your tax prep fees because your CPA is going to have to file a corporate tax return in addition to your personal tax return. And that corporate tax return is then going to issue you a K-1 that is going to show you what your salary or what your distributions were. Okay. But again, the audit risk is much lower because we have a clear separation. And with an LLC or an S Corp, you're basically documenting it, right? You're keeping everything separate, all your business expenses you're running through the business, the income is coming out just as a salary or a distribution. So you don't have the commingling like you sometimes see with a sole proprietorship, which is why it reduces that risk of audit. So with an LLC, the advantage is you're giving yourself that bubble of protection, right? You're creating that legal wall between personal and business. The key here is we have to protect the veil between personal and business, because there is a way to pierce that veil so that, let's say you are sued and they want to get at your personal assets. There is a way to do that if you have not maintained it properly. So you have to keep those clear boundaries. What that looks like is don't pay your personal expenses from your business account. Don't commingle, right? Keep business in the business, personal in the personal. Make sure you're filing your reports every year, which we'll talk about. And sometimes, depending on what you're holding yourself out to do, it gives a little bit of professional credibility because now you have an LLC, right? Rather than a sole proprietor. So depending on, again, personal and professional goals and what you're trying to build, those are some benefits of an LLC. So how do we maintain that corporate veil? Like I said, no commingling. So you have to be really careful with that. Don't pay personal bills from your business card. There was a case, I can't remember what state it was out of, but essentially it was I think it was a dog camp, and the owner of the LLC did not keep the LLC separate. He was paying his house payment out of his business account. Like anybody that used the camp, he was taking all the revenue generated, putting it in the business account, but then he'd turn around and pay his personal bills out of that. He didn't keep enough money in the business account, and then assets he had in his personal name. So like there was no clear separation, there was commingling. He was sued and he actually was found to be personally liable because he didn't maintain that corporate veil. So that's a key. And it's simple to do. You just want to be very intentional. And then from a legal identity standpoint, everything you sign for your LLC, you're acting on behalf of the LLC, and you make it clear that you're not signing as yourself personally. And then you want to have maintaining your corporate book. With an LLC, it's very simple. We don't have all the formalities as we would have in a corporation. And so you can maintain those minutes and resolutions. I typically just say, if you have major things you do in a year, document it with a simple minutes of a meeting and put it in there. So from a compliance standpoint for an S corporation, because you are then paying yourself a payroll, you have payroll filings. Okay. I mean, unless you love filing tax returns and filling out tax paperwork, it makes sense if you do go the step to form an S corporation, to have a payroll company handling this piece for you. It's just so much more efficient than you trying to figure it out. They will file your quarterly 941s. You then are issuing yourself a W-2 at the end of the year for your salary. But you have to file quarterly taxes, pay quarterly taxes, file your annual report with the state to keep your LLC active, right? This is a piece that a lot of people that have LLCs forget. As of this year, the state has stopped mailing annual reminders. Now they email. So if you haven't kept your email up to date with the state and you don't remember filing your annual report this year, you might check to make sure you're active still. And then with an S corp or an LLC, your tax return is due by March 15th. Okay. So typically tax returns are due from a personal standpoint, April 15th. When you have an S corp, they're going to be due in March. All right. And then there is a new tax deduction, and this is something again, talk to your CPAs about. But with the new tax laws, you may be able to deduct up to the first 20% of your business income from your taxable income. That is before any deductions. Okay, so we're going to talk about deductions as well. So this, I believe it's up to a certain income, and I want to say it's about 195,000 for an individual. So this may give you more of a tax benefit. So again, something to talk with your CPA about. And then with an independent contractor, because your employer is not paying your taxes, right? They're not withholding it because you don't have a paycheck. You need to remember to pay those on your own. So typically, we've kind of broken it down here by quarter. You want to make sure that you're auditing. I say in Q1, it's a good time to review, right? Audit your independent contractor agreement, make sure you have it, keep it on hand. Update any mileage apps. So mileage is a deduction, which we're going to talk about in a minute. There are apps that you can just put on your phone and they'll track that for you. Make it as easy as possible, as much as you can automate, the less you have to track. In Q2 is when your first estimated payments are going to come due. So make sure you're paying those. If for some reason you have missed one of your estimated tax payments, is you can catch it up just as long as you pay at least 90% of what your tax liability was the previous year, then you can avoid penalties. So if you don't pay in any estimates, potentially you're going to have penalties in the next year. So just make sure you're paying those. Again, if you use a CPA, they can help you figure out what those should be. And then in Q3 is a really good time to kind of assess where you're at. In Q3, you still have time to implement some strategies so that you can reduce your potential tax liability. Look at different strategies, look at some of those new tax laws, and if you're going to fall into some of those categories where you can take advantage of that. And then your expenses. So if you work with a CPA that can help you strategize, sometimes you can time things so that you can reduce your tax liability strategically that way. And then in Q4, then you're kind of auditing, where does it look like you're ending up for the year? At Q4, you might be too late to do strategy. So you really want to start looking at different strategies in Q3. And then part 3 is looking at operational excellence. So how do we build systems for long-term compliance? So with independent contractors, you're your own business. And what we see is that to have a really strong business, there's 4 key pillars. There's legal, insurance, financial, and tax systems. And if you're weak in any of those pillars, it can potentially have a rocky foundation for your business. And again, this might depend on what your long-term personal and professional goals are. But when we look at the legal portion, are you the right entity, right? Is sole proprietor the right entity? Should you be an LLC? Should you make the S Corp election? Do you have contracts in place? Do you have your independent contractor agreement? Do you have, for anyone that might be working for you, do you have written agreements? Have you maintained your corporate book and have your annual minutes? Have you filed your annual reports? Okay. Insurance. Insurance is our next pillar. Insurance is typically going to be your first line of defense, right? If you're sued, you want to make sure you have your E&O insurance, your general liability insurance. A big area right now is cyber coverage. So depending on what type of information you have on potential clients, do you need that coverage? How do you mitigate risk? Right? So if you have any type of claim, we want to make sure you have proper insurance. If you have If you haven't reviewed your insurance with your agent in a while, I would recommend that you also do that. There are umbrella policies that can give a whole nother layer of protection. Um, and then the third pillar is the financial, making sure you have those financial systems in place. So again, having things separated, making sure that your business accounts are separate from your personal accounts, making sure you're tracking your expenses, your deductions, because those expenses are going to be deductions that's going to reduce your taxable income. Right? I don't think anybody wants to pay more tax than what they have to. So we want to make sure we track all of that. Um, Cash flow management, making sure that you have sufficient savings to pay for those estimated taxes or any other expenses that could come up. Um, and then finally, your tax pillar. And at a minimum, making sure you're paying your estimated quarterly payments in, but also looking at how can we strategically reduce taxes. If you do not have an entity, so if you're a sole proprietor and you're thinking, maybe you should form an LLC, here's the process. Um, it starts with filing in articles of organization with the state of Michigan, okay, and naming a resident agent, which is probably going to be you. And that you file with the state, there's a $50 filing fee. And then you also need to get an employer identification number with the IRS. Think of that as your social security number for your business. So once you have your articles of organization and you have your EIN, then you can open a bank account in the name of your business. Um, and again, you're going to keep everything separate. You're not going to commingle anything. That gives you the most protection and reduces liability. And then if you are at a stage where making the S Corp election makes sense, then you can make that if it's applicable. And when we look at those pillars of the foundation of a good entity, we want to have a what if plan. Okay. As an independent contractor, you're your own business. So what happens if you're incapacitated? Who can step in, right? What if it's just a temporary incapacitation? What if you're in a car accident and you're out of commission for a week or two? Who can step in and continue to manage your business for you? This is where powers of attorney can come into play. In your industry, I'm gonna guess that you need to have somebody who's licensed, right? And so a lot of times we'll work with professionals, especially licensed professionals, where they pick somebody that they can trust that can step in if they need to help them out, help the business, keep the business going until they're able to get back to it. And what about the client database? If something does happen where you pass away, now what happens? Having that succession plan so that one, your clients are taken care of, but also so that if there is something then to pass on to loved ones, whether it's goodwill of the company, maybe it's a database of clients that another agent might be willing to pay for. We want to make sure somebody has authority to wind that down, even if maybe the main asset is a bank account. Who can step in? So this is part of that estate planning. Estate planning is also business planning. Okay. So having that what if plan, managing risk and liability, we talked about that with proper insurance. Even if your broker has insurance, still talk with an agent and make sure you're properly covered. Okay. Understand the deductibles, understand your limits. If you read your policy and you don't understand it, sit down with your agent and have them explain it to you. Same thing with your tax return. If you read your tax return and you don't know what every line item on there is, have your CPA explain it to you. Okay, because you're going to be held responsible for understanding it, especially since you're signing it. Don't commingle things. Keep everything separate. If we commingle, then potentially if you have an LLC, that corporate veil could be pierced, which means you have personal liability, and it could invite IRS scrutiny, right? We don't want any IRS attention on us. Cyber coverage, again, that goes back to the insurance. We want to make sure that that digital data is protected. And then record retention. So record retention is making sure you're keeping logs of expenses. If you have mileage, make sure you're keeping logs. If you use an app on your phone, that should have your mileage recorded. Keep receipts for all of your expenses. And then as far as expenses, maximize your deductibility on things. Okay. So keep a log. What can you deduct? Because this is going to then reduce your income and reduce the tax. So just to give you a couple ideas, if you buy a new suit because you're going to wear it to showings and wear it to meet with clients, you cannot deduct that. Okay, because that's a general use type of thing that you can wear anywhere. Driving to your broker office, not deductible. Driving to meet with clients, driving to showings, absolutely, you can deduct that. Dry cleanings, can't deduct that. What can you deduct? Let's say you buy snacks for an open house, or you pay for continuing ed, or your dues, or marketing, right? Advertising, anything from the business. And then we have a maybe list. Excuse me. And this is going to depend on how you use it. If you have a home office, if it's like a spare bedroom in your house and it's a guest room part of the time it's your office, or you share an office at home with your spouse or another family member, maybe you can't really deduct that, right? However, if you have an exclusive space in your home that you only use for your home office, then you likely can deduct that as long as you're doing certain things there. So if you say you only work on your books, balancing your books, writing out your expenses, whatever, in your home office, then you can deduct that space. And there is a way to calculate what that is. And then you can deduct that. A cell phone plan. If the cell phone is also personal use, then you can deduct a percentage of it that you use for business, and then client gifts up to a $25 limit. Okay. Now, if you are, let's say, taking a potential client out to lunch or something like that, that's going to be a 50% deduction, right, for meals and entertainment. So this is something I typically say, keep your log, make your list, take it to your CPA, okay? Because you want to maximize that. These things can add up and greatly reduce your taxable income. And then mileage. There's two different ways that you can deduct mileage. You can take your standard deduction, where for all of your mileage that you can deduct, you basically get 72.5 cents per mile for 2026. This changes every year. Or you can take actual, and the actual expense is looking at how much are you paying for gas, oil changes, maintenance, all of that. Okay. And if you have a luxury, there's a luxury SUV exemption or depreciation, where if you buy a luxury vehicle that I believe is over 6,000 pounds and you use for about 80% in the business, then you can use this tax code that gives you accelerated depreciation, and that vehicle would then be owned by your business, right? And so again, these are things to talk with your CPA about, especially if your CPA hasn't mentioned any strategies to try to save you taxes. These are some things you can bring up. Some CPAs are fantastic at doing tax returns, and they don't always have the time to sit down and go through the strategy. So make sure you're bringing these things up to your CPA. And then keeping your paper trail. Again, make sure you're tracking everything. You can use apps that will help you keep receipts, QuickBooks. You can just snap pictures of your receipts so you have them all in one place. Or you can use the envelope method. You just put them all in an envelope and take those to your CPA. They love that. So that is pretty much securing your business, right? That business foundation as an independent contractor, you are your own business. If you have LLCs, right, you've taken that first step to add some limited liability there as well. All right. Any questions?